Good morning and welcome to the Orlando Real Estate Buzz. I'm Brenden Rendo with the Homes in Orlando team and joined as always by Joseph Dionne of Aptly Home Loans. Nice, little bit quieter week than we've had in a while.
Yeah.
Could kind of sit back and not spend my day, looking at the news going, holy cow, what the heck's going on?
It's great, but, I was able to enjoy my cup of coffee with no stress, but I kind of like the stress because it gives us more to talk about.
Yeah. So, I mean, just it's kind of nice. We're going to take a look back at last year, some of the numbers, where are homeowners sitting and kind of what we think we're going to see this year. I'm torn. Some parts of me say it's going to be a much better year. Some parts are, I'm still being a little bit cautious overall. You know what I mean?
Mm-hmm.
So sit back and welcome to the Orlando Real Estate Buzz. So, Joe, let's just take a look back at some of the stuff from last year. We knew the past couple of years has been kind of slow. And when you look at it, when you look here at the numbers, 2023, 2024, 2025, not a whole lot of sales. This year we were just shy of that 4 million home sales. Mm-hmm. And when you go back and you look at, the peak back in 2020 and 2021, even 2022 wasn't bad. It's when we started to see the decline. Really, with the rates going up and everything, you saw that market just really tighten overall. Yeah. And I'm kind of thinking maybe this year, maybe we push up to maybe 4.5 million.
I would hope so. I feel like a lot of, you look at that data and you look at this graph and you see 23, 24, 25, it's pretty much flat. Like, I think, it's hard to tell, but I think they said that we had a resounding 1.4% year over year growth from 24 to 25 on existing home sales. That's not much. And a lot of it is that there's been so much uncertainty. Like, you're coming from some of the lowest, like historically may never, ever happen again, interest rates on mortgages. And then you get the uncertainty. And then, so I understand the 23 and then the 24 and 25 just kind of felt like, because we never got a good pattern, mm-hmm. people got locked up, meaning like rates would be up and then they'd be down and then they'd be up again. And then they would go here. Mm-hmm. And it's like, it's hard to figure out a plan when you're like, okay, well, this month I'm estimating this. Okay, next month I got to buy less home because mortgages went up. Maybe they'll go back down. So I'm going to wait. And you playing this game. And a lot of people kind of just, all right, if I don't have to, I don't have to.
Yeah.
Like, I don't want to play the game.
Yeah. Which makes a lot of sense because, this is a report just released by Realtor.com. And you look at the amount of equity people are sitting on in their homes right now. They're estimating, 71.6% of real estate is sitting in equity, which is basically the difference between what you owe and what your house is worth. Mm-hmm. So when you're sitting on that much equity, you're not in as much of a hurry to make a move. I don't think. I think it caused a lot of people to sit back and double think before they actually just jumped and made a move. Wherein, 2020, 2021, you had to make that move because the rates were just so good and you wanted to lock in the rates. Yeah. Now there's a lot more calculation for people overall before they make that move.
For sure. Yeah, exactly. And the one thing that I think this does a great job of is, and I see the notation says remaining above mid 2000 levels. That's like, that was, you're talking, the housing collapse, whatever. Right. But if you look back and you go, okay, well, they're saying if equity declines by 20%, we're still greater. If you just go all the way to the left, really your equity position for homeowners is still above what it was in 1990.
Yeah.
Like that's that's huge. And I think that's the bigger picture for me is like, that's a 20% decline. Like we're not going to see a 20% decline.
Yep.
Like, so that's something, that would be earth shattering if we were to see something like that. That's not going to happen.
Yeah. It's not going to happen. And then the other interesting thing that they came out with this week is, I'm sorry, the share of mortgages greater than 6% now exceeds the share below 3%.
Okay.
So a lot of people are saying, well, maybe this is the point that we start to unlock some of the people who feel locked in.
Yeah.
But I'm kind of looking at the whole cumulative look where you still have 80% of the market below that 6% rate. And if you look at the share between 3 and 4%, that's sitting here at 1%, which is that's where I'm sitting. So I've got a 3% 20-year mortgage, and I still, quite honestly, feel locked in to where I'm not moving because of the difference that it would cause me in payments for a comparable house.
Yeah, and I think it is interesting if you look at the graph. Obviously, rates have been higher, so that percentage is going to go up, and the others is going to slowly go down. But if I look at this and you go from 2022 to 2026, the start of it, you're seeing those numbers really placate, and the ones that you mentioned, like the highest percentages, the share that's 3 to 4, right? That's still 31.5, but it's seen the biggest drop, right? Like 9-point drop, whereas the others have seen, if you had a sub 3, those feel like necessity sales, right? Like you have to sell. But you talk to the clients now, and in the conversations that I have for the clients that are in their rates are in the high 4s, like they're not really like our rates higher, yes, but they're having a different conversation with me than the ones that had the rates in the 3s, like yourself, and you sit there, or the low 4s, because they're going, okay, prices are higher, we have this, and then it's really the full payment shock, and they're like, wait a minute, like I can sell my home for maybe $400,000, I paid $200,000, I could sell it for $400,000, but I'm trying to buy a $500,000 home, and I don't want to put everything toward the new home. So I want to put $20,000. So I'll do a loan of $400,000. I'll keep $100K in my bank or whatnot. And they start playing with all their numbers and figuring it out. And they're like, holy cow, my payment's still $1,000 more than it is now, or $1,500 more. And you're like, well, you're buying a $500,000 home. And the part that a lot of people, like the part that's the hard part to chew on the move up is, especially here in Florida, in a lot of states that have higher property taxes, is we have higher insurance, we have higher property tax. Now they've been impacted a little bit by the insurance. But you buy a bigger home, insurance is going to be more, obviously. Yes. And then property taxes is the piece, because now we've had enough years that all these property taxes have really started to move up to where the new values are. And that's where people are going. That's where I feel like the big payment shock is.
Yeah. I know one thing I do with all my buyers is when we're looking at houses and we're getting ready to put in offers, is we use the calculators that a lot of the counties have now, where you can put in the value of the house and actually calculate what your new tax bill is going to be. And because some of these people have had these homesteads for 15, 20 years, it triples or quadruples the tax bill on those houses. And it's a shock. So you've got to be able to like look at it up front and say, okay, according to Seminole County, they've got a nice easy one to use. Even if we're bringing in homestead and portability, we're still going to end up twice with a tax bill that's twice as high as the current tax bill on that property. So you're right, you're getting hit on that as well as the increase in the payment. And I think that is where a lot of people are getting the shock, and it's like, oh, they think twice before they actually make that move, because it's a calculation you have to evaluate overall for people. So So we're seeing this, and we got a lot of things going on in the economy. One thing that we've seen that could affect rates is the trade deficit took a huge dive in the final quarter of this year. And the Atlanta Fed changed their projection on GDP to an increase of about 5.4% for the coming year, which that would be a huge increase. And what we're seeing is with the rates is the 10-year, it hasn't taken that dive that we've seen, that a lot of people were hoping for. We're really kind of been sitting in a very solid range between 4.12 and say 4.2. And what's interesting though is even though it's a little bit higher, the one thing we have seen start to be squeezed, and we still have room for it, is the margin between the 10-year T and the 30-year mortgage rate. Where last couple of years we've really been sitting around 2.5% margin, we're seeing that starting to be squeezed down to around 2%. So I think some of these mortgage lenders are starting to feel a little more comfortable that that the market's going to be a little more stable. And I think part of that is they are seeing, the number of people with the 6% is higher than the ones sitting at the 3 and 2, because they're not going to, I don't think they have to fear about the refinances coming in. It was interesting because I apologize, I forgot the gentleman's name, but one of the top investors in the world suggested putting prepayment penalties on 30-year mortgages to help bring mortgage rates down. And the whole philosophy behind that is that if an investor is guaranteed a rate for 2 years or 3 years, that they'll bring the rate down because they know they're locked into this rate, and they know they can then calculate how quickly they can get their investment back and actually make a profit. So I thought that one was kind of interesting.
Yeah, I mean, you see that in the investor marketplace right now, right? Where a lot of debt service loans, a lot of investor products, and so they have these prepayment penalties, and they've been removed off your standard products, which you don't want to lock in someone. Like, I see both sides of the argument, because from a purely X's and O's, like, it makes sense to sit there and say, hey, like, we want to see things go down. How do we guarantee that we're going to get at least a certain amount? Because everything's risk based, like you said. Like, if somebody's buying these mortgage backs, they're sitting there going, all right, there's a cost. Like, the bank that originates it, there's a cost. There's this. Like, typically the break even point on just the initial piece is 18 to 24 months just to break even. That's not to make money, right? And then to make money is very small. So that's the part where it's if there is a mechanism that way, it does create a avenue that I could see rates do get a little bit more aggressive, because now they know, okay, I'm locked in. I know I'm going to at least get X no matter what.
Yeah. It's interesting because as a homeowner, if you came to me and said, Brenden, we can give you a 30-year mortgage without a prepayment penalty at 6%. If you take a 3-year prepayment penalty, I can give it to you at, say, 5.625. Would you take it?
Yeah.
Well, that would be an interesting option to take.
My concern is and I'm thinking just public service. This is where I think a lot of people will go is, will the consumer understand, A, that they got two options, or B, will they just get the lower interest rate option and not fully understand that there's a prepayment? And the thing is like, most consumer, like, what's the average time in a home right now in a mortgage? It's like 7. I mean, we say it's 7 years, but it's really like 9 now, right?
Yeah, it's definitely gone up.
And I think so a 2-year doesn't really make too much of a difference, but it is, if you have someone that's relocating for work or they're moving to a new area, they may not know if they're going to stay in that area, this and that. They may be a little bit more cautious on it. But the average person's going to be like, yeah, like, it doesn't matter. Like, like if I had the option, when I buy my home, I take the lower rate because I'm like, I don't plan on moving quickly.
Yep.
I'm trying to build a family. I don't want to move my family around, right? Like, and I think a lot of people would. So I think that is very interesting. And this isn't really a hypothetical. Like, we have this data from products that already exist. We see these spreads of like, hey, if you take a prepayment penalty, you get a better rate. Like, when it comes to these investment loans, if you want a zero, debt service credit ratio loan with zero prepayment penalty, usually it is 0.75% to 0.5% higher rate than a 2 or 3.
So it's just, I thought it was a very interesting conversation. It's something that, as affordability, I mean, that is the word of 2025. I think it's the word of 2026, looking at different solutions to find affordability. So, but with getting back to the trade deficit, the increased GDP, we come and watch the Fed watch, which is coming up, in a couple of weeks on the 28th. 95% of the market saying we're not going to get a rate cut this time, which I don't think we need. I think we need to allow, because they say it takes 12 to 18 months for rate cuts to really work through the economy. I think we need to allow some time for those to get through the economy, because I mean, when we look at unemployment, the unemployment report from yesterday came out. 198,000 new claims was actually a decrease of about 9,000 from the previous week. So it's not really peaking up. It's not going down. It's just kind of, unemployment's been kind of steady. Not, you've heard a lot of stuff. A lot of layoffs, things like that. But we're still pretty steady in that. So the economy may have hit the bottom Q4 this past year.
Yeah.
And I do see some optimism in a lot of people I talk to for 2026, which is a nice feeling. But maybe that's where we're, I think we can have a better year. And I think there's going to be some opportunities for both sellers and home buyers this year. So when we, now we get into our numbers here locally, we had a short week, the final week of January 4th to January 10th, really kind of took a hit, 284 sales, which is extremely low. We actually did, for the first time in about 5 or 6 weeks, we saw an increase in the inventory. And I think going into February, end of January, you're going to start seeing sellers again starting to put their houses back on the market. Because last year we had the biggest number of withdrawals we've had in ages. And I think a lot of people are waiting for that spring to put their houses back on the market. And this could be an actual good time for sellers to try and beat some people to the market and have a new opportunity. For instance, I'm meeting with a client today about listing their home. And when you look at their homes in the 32765 area, haven't been a lot of new listings, but there's been a lot of properties that have been sitting on the market for 50 to 120 days. So kind of becoming stale. So being able to have a new house come on the market, if we price it right and present it right, we should be able to get it under contract, I think, fairly quickly within a couple of weeks, because I think a lot of buyers are kind of starving for some new inventory out there, especially with all the withdrawals. Condos, 66. I mean, condos, I don't know when that market's ever going to increase. Inventory there went up 94 units. Our months of inventory actually went up a little bit. That's because of decreased sales to 6.5. And our original list, the sales price, still sitting down at that 92% rate. So there's still plenty of room to negotiate deals out there. And days on market sitting at 74. So, sellers, no seller wants to see their house sit for 74 days. They really want to try and get it gone within the first 30, worst 60.
Yeah.
And then, when we look graphically at our sales, you can see that, going into mid-December, which is surprising because I thought we'd have a little bit of more of an increase. Really kind of down overall. And then, of course, here's the first increase in inventory that we've seen in several weeks, really since beginning of November. You know, we had seen a continuous decline overall in the inventory. And the one thing we are still seeing is with the number of withdrawals. We're still seeing a high number of withdrawals. You know, end of the year we peaked at 251 right before the new year, but the first week we had 148 homes withdrawn from the market. So we had 86 on, but 148 withdrawn. So that needs to turn around for the buyers because the inventory has shrunk a little bit. So your choices are down from what you had previously. And I think that may start affecting the overall numbers of what you can negotiate. You know, less inventory, of course. And then for the condos, you know, we are up to 14 months of inventory in condos. That is amazing. That's a lot of condos that are not moving. And I actually saw where over by Disney, they're going to start building a new luxury condo. And I'm like, why would you build a condo complex now? Who's ever
new and exciting. It's going to be built to code. It's like the only concern with that is like that may negatively impact all the other communities around them.
Yeah. I'd like to see the one who did the math on that project. You know, when did they start it? Like 6 years ago? You're still working on 6-year-old numbers. So the market overall in Orlando, we're a very steady market overall. You know, no real high, no real peaks, no real valleys, but consistent. And that's, I think, what a lot of sellers and a lot of buyers are looking for is consistency and the ability to actually figure out without, like you said, panicking like we have the past couple of years of what happens if the rate goes up a half a point, you know, in 2 days. What if it drops in 2 days? You know, all that watching. I think people are much more comfortable. We've sat pretty steady. You know, Friday we took the little dip below 6% because of Trump's opening up his mouth. Well, we've gone back up to just over 6%. So, and I think it's bringing some people off the sidelines. He said, you know, purchase mortgage applications are up about 8-9% the previous week from where they were before. So could be. I think I want to be optimistic this year and think that it's going to be a good year for both the sellers, for the buyers. I think there's going to be good opportunities for both sides to get what they want and feel like they've won on their side of the transaction. So what's your outlook? What are you thinking?
I don't know. Like, I feel like this year is going to be interesting. I think we're going to have the concern is my bigger concern this year is going to be geopolitical tension. And I think those are going to be the things that, you know, I think if we held steady and we don't have outside forces, we'll see the housing industry and we'll see rates naturally kind of continue to drop a little bit. I think we could be looking at some of the best rates that we've had in years within, 90, 180 days might be the best rates that we might see for a long time. Like, I don't know if we're going to continue to see compression and keep drop. But I think what could impact us is going to be a lot of this tension and stuff. And then the challenge with a lot of this is we're a society that reacts based off of what we see, off of emotion a lot of times. Yeah. And this is true in the bond markets, the people buying and trading and all of this stuff. So if we see things that happen that could be good for rates, is it tied to or bad for rates? Is it tied to strengthening or worsening in the economy? Is it tied to tensions geopolitically? Is it tied to, what is it tied to? And depending on what it's tied to, will it have a lasting impact? I think that's my biggest concern is if we continue to see what we've kind of seen with Trump, which I don't know. Like, I don't know how to feel about it. Like, I kind of do think every once in a while, you know, we need to flex our muscle, right?
Mm-hmm.
And we need to let them know, like, hey, like, we are, you know, who we are. Like, you know, like, I think it was a big culture shock when we did what we did recently. And a lot of people, other countries were like, oh, snap, they are miles ahead of where we are. Like, because I did feel like, you know, and I'm not saying this is good or bad. I don't know how to, but I think a lot of countries were like, their military is not that big of a threat.
Yeah.
Like, and they were I felt like a lot of countries were bowing up to be like, I'll take you on.
Yeah.
And I think some of them backed off when they saw what happened. And they were like, wait, they did what? How quick?
2 hours?
How precise? They did what? And then, you know, they're like, you know, we saw things like that we never knew existed from the U.S. military. Like that's eye-opening. But that creates some scary, like there's a very scary application to that. But I think there was good that came from it too. And my concern is that if there's too much of this in 2026, it could create a lot of volatility that has ripple effects into every other area of the economy. Yeah,
I agree with you wholeheartedly. That's the one thing that we have absolutely no control over. You know, it will be interesting. Hopefully, you know, you'll see things move smoothly, like in Iran right now, without having to do any strikes. The transition in Venezuela go well as well. And you're right. Just it can move our market quickly on a dime, one way or the other.
Yep.
So, well, thank you everyone for joining us as always. Please come back next Thursday. If you're on YouTube, Facebook, please like and subscribe. And we'll be here again next week on the Orlando Real Estate Buzz. Thanks, Joe. We'll catch you later.
Bye-bye. Appreciate you guys.